that when you are leaving the country, CRA wants to make sure that the assets you own or the unrealized capital gain you have accrued on all those assets, CRA takes its due share before you become non-resident, because in more often than not, in most of the cases, for most of the assets, CRA might not have control on recovering their share of capital gain when you leave.
So, Amir, how are you?
I'm good. How are you doing?
All well, all well. It's been, I think, 2 months now that we met last time here in Dubai, and it was a really insightful conversation that we did in Urdu language. The podcast is there available on my Urdu channel. I thought that same because a lot of comments on that podcast came from some people who did not get what we were saying, and they were saying that it's a pity that this information is not available in English language, and many people were asking for this because I think it was this video was coming into search, and the topic was as such that maybe a lot of content is not available on internet. So I thought that why not to have this on my English channel as well as Urdu channel. I'll just upload this on Urdu channel as well, just so that if somebody has missed it earlier. So, anyways, if you can give us a brief introduction of yours, if somebody has not known you yet, and I will add the in the description. I'll add your LinkedIn and other socials in the description of this video. But let us know about yourself first.
Thank you. So, my name is Amir. I am a cross-border tax accountant. My accounting and tax practice operates in Canada, US, and UAE. We do personal taxes, plus we do business taxes, bookkeeping, payroll, company formation, all of that stuff, business consulting as well. And because we do taxes in these three countries, so we can give a, a comprehensive or holistic service when it comes to your tax planning, especially when multiple countries are involved or when a cross-border tax planning is required between Canada or US, Canada, UAE, US, UAE, whatever combination for these three countries.
Great. So, but and you're based in Canada right now.
Yeah, personally, I'm based in Canada, but our offices are there in Canada as well as UAE. Plus, US, we operate remotely, but we have a lot of clientele in US as well. Most of them are cross-border clientele.
Okay. So let's I will discuss with you a lot of topics here. But to start with, what are the kind of queries that you're getting right now, either from Canada or the UAE? Because I think UAE is the hub of a lot of Canadians who might have made UAE as their second home, or a lot of people who are going to Canada from UAE for the first time. So, what kind of queries are very common that you are receiving right now?
Okay, interestingly, I have seen a shift in trend. Few years back, the queries were that I am in Dubai, I want to move to Canada, and how would it work for the saving I'm bringing in, or I became PR, 2 years back, I did a soft landing, and now I am coming for good. How CRA would treat my this thing and that thing and this matter and that matter, what would happen to my childcare benefit, this, that, and all that stuff. So that was mainly for the people focused on moving from Dubai or UAE or Middle East to Canada. But lately, the shift I am seeing is the other way around. Now, most of the queries I am getting are related to people moving out of Canada, either to US or to UAE. And again, the questions are with respect to what would be the tax implication, because they have lived here. Either they are the ones who have lived here for their whole life, or they are the ones who came 5 years, 10 years back, and they have some assets here, some sorts of income here, which will continue, like rental income or maybe investments here, and they want to know that if they move to UAE, first of all, how that would impact from tax perspective going forward, how that is going to impact from the exit tax point of view. So that's one big change I have seen between Canada UAE corridor, I would say. And Canada US is again kind of same questions, but a very different scenario when it compares Canada US versus Canada UAE, because the tax laws are totally different in US versus UAE. Um, for people who are in US or moving to UAE, and or the vice versa, again they have a totally different context, because US is one of those countries where taxation is citizenship based. So it's not that you just cut your ties and you don't have to worry about taxes. They still have to worry about it, so they need much more detailed planning when it comes to US expats living in UAE. In fact, the number of days they spend in US while they are US expats, that affects certain benefits they can get or certain deductions or exclusion they can get in their tax income. So how many days you are staying in US while you are a US person living in UAE, that can affect your taxes as well. So consult with me before you book your vacations to US.
Right. Actually, I have seen this is a very common observation from my side, and I've talked to a lot of people as well. That we see a lot of expats here in the UAE, like from Canada, UK, US. Not US, sorry, Canada, UAE, Canada, UK, Europe, Australia, New Zealand, even South Asia, everywhere. But the minority expats that I can see, although this market is huge, the US expats are not in that kind of number that I can see here in the UAE. And two reasons I can see of this phenomena is one, that US is a big market. It's already giving a lot of opportunities to a lot of people, even though with high taxes. So a lot of people might not consider moving from the US because they are already getting good, let's say, income while in the US. The second problem is that US is, I think, US is the second country in the world. I mean, the only there are only two countries that I know of. There is one country in the Africa, I think Eritrea, and the US, which are taxing their citizens abroad as well, whether they are living for 365 days, 180 days, or whatever the case is. You have to pay certain amount of tax while you are expat, being a US citizen. So this is why I think there are very less number of US citizens here in the UAE. So US is a different ball game. So we're not going to touch US right now, because predominantly my audience is from the UAE and Canada. So let's say if somebody is from the, as you're saying, that there are a lot of Curies from Canadians who are moving to the UAE, and probably because there are a lot of news that I can see while sitting here in Dubai, that there is high inflation, there is high taxes, there is a high cost of living, which is unheard of before in Dubai. But now we are seeing a lot of housing inflation here in the UAE as well, because a lot of people are coming in, and of course, it takes time to build houses. So, what are the questions? Let's say, what are the precautions somebody should take while they are moving from Canada to Dubai or anywhere in the world? Dubai we are going to talk about, because there is zero taxes in terms of their income. But as they are coming from Canada, they might be liable to pay taxes in Canada, even though they're not there. So if you can break us in different scenarios, different permutation and combination, and I'll add from my side as well some points. But from your side, what are the main points that one should think about?
Okay, so I think the starting point would be to become a non-resident, because obviously most of the people who would be moving out of Canada, they would not want to pay taxes in Canada for their worldwide income after that point. Most of the time, that's the whole reason of moving, or there might be other reasons, but obviously they don't want to pay Canadian taxes, because not that you have to pay, but there's additional compliance requirement. So if you are moving out of Canada and your intent is to become non-resident, so people should know that just because they move out of Canada and just because they spend less than 183 days in Canada does not make them automatically a non-resident of Canada. And this I'm talking about Canadian citizens or permanent residents. So this 183 day, this is one of the biggest misinformation I have seen among people who come to me for advice. And especially if they come to me after a few years of becoming non-resident, that I never told anyone that I become a non-resident. I did not live in Canada for 183 days, so obviously I'm not a resident, so I did not pay any tax, I did not file anything, I didn't tell anybody. I don't have to tell, because I spent less than 183 days. So in Canada, that 183-day criteria is for visitors or for people who are not permanent resident, who are not a citizen. So for them, the criteria is that if they stay more than 183 days, they have to pay taxes, they have to file taxes. But for those who are citizen and resident, only the fact that you are out of Canada doesn't make you non-resident. First of all, you have to ensure you cut your ties, and secondly, you have to ensure that you make a proper communication. So, for first, let's talk about cutting your ties. So, one of the biggest tie which can still make you a deemed Canadian resident while you are out of the country is your family, your spouse, and your dependent kids. So let's suppose it when we have seen number of situations where one of the family member might get a job in Middle East and they would move here, but the wife and kids are still there and living there, and this particular person is in moved to, let's say, Dubai, and doing a job. So the bad news is that they are a deemed Canadian tax residents because they have a very strong tie to Canada, and that is their family. So first important tie that you need to cut is your spouse and your dependent kids cannot be in Canada while you intend to be a non-resident, right?
So you're telling me that let's say if let's say I'm in Canada and I've got 3 kids, wife as well, and I got a good job here in Dubai and paying me very good amount, and I thought that okay, just let me go there first and settle myself in Dubai for let's say 1 year, and during this time maybe my family's my kids are doing schools. Once they finish this, in the meanwhile, I'll save some money as well. And then after that 1 year, maybe my family would come, or I will see if I would be able to settle or not. Just let me go there and then see. But during this time, you're saying that if my family is back home in Canada, I cannot be considered as non-resident Canadian. Is it like that?
There is a slim exception, but except that exception, I'll just describe that exception. But without that exception, that's true. The entire family has to be moved out of the country to be called a non-resident. Otherwise, you are a deemed resident of Canada.
Okay.
Um, yeah, but before going to that exception, let me tell you, your audience, a very general thing that in addition to what we are discussing, which is based on the tax laws of both the countries, there are tax treaties as well. So normally tax treaties override tax laws, and tax treaties are very specific to the condition and circumstances. So there might be a situation where we are discussing might not apply to you, and there might be a clause in tax treaty that might be helpful in your scenario. So that could be a different thing, right? But for now, we are talking about for the general audience, so we are not considering what tax treaty says. That
Mm-hmm.
actually happens more in case of US Canada rather than Canada UAE.
If you want to start your journey of investing in real estate of Dubai, there are two platforms that I personally use to invest. One is SmartCrowd, the other one is the Stake. These platforms allows you to invest in Dubai's property through fractional ownership. You will be able to get monthly rentals based on whatever investment you have done. If you use the referral link mentioned in the description below, you will get the referral bonus of 250 dirhams as soon as you start investing. Now let's get back to the video.
Generally speaking, if your family is here in Canada, you cannot be considered a non-resident. And as I mentioned, there is an exception. So let me tell you that exception. The exception is if prior to becoming Canadian resident or Canadian citizen, you were resident of another country and you are re-establishing your ties with that country. So that is an exception where, one spouse can become a non-resident earlier, and within a reasonable time the other spouse becomes non-resident. So the important criteria is you are re-establishing your ties. It's not a new country. So if you had lived in Dubai or UAE, you moved to Canada, you spent 4 5 years there, now you're getting a job, you came back to Dubai again. And when I say reasonable time means, let's suppose, the example actually given by CRA is, the other spouse needs to wind up everything and sell the house. But another good example is the school year. So if your kid has a school year which is about to finish in, let's say, 6 months, and one spouse moves out first and re-establishing his ties, and the second spouse moves later, so that is a very slim exception given by the tax law. But apart from that, the general rule is your family has to be with you out of Canada. So
So,
that was the first
so
time. Yeah.
okay. So if I repeat this, so let's say if I'm first case, if I'm based in, let's say I'm from Pakistan, so I'm based in Pakistan, and I go directly to Canada on
Mhm,
immigration, and
mhm,
then now I've got the passport and everything, and now I've got an opportunity here in Dubai, and
mhm,
I'm going to Dubai. In this case, I have never been a Dubai resident before. So in this case, this exception will not get implemented to me, right?
That's correct.
Okay. So the second point is that, let's say if I've been here in Dubai for 10 years, and then after that I've gotten Canadian immigration, and I went with my family to Canada for 5 years. I've been there. I've got the passport. Now I've got another job opportunity here in Dubai. Now if I come back and my family stays there in Canada for, let's say, 6 months or 7 months, just because of some of the technical issues, then those 6 months can be considered as me being a non-resident, just because of the fact that I was in Dubai. But let's say
Yes.
if I was in Dubai earlier as a resident, but now I'm getting a job in Saudi Arabia. So if that is the case, the exception will not get implemented, right?
Yes, because they go country by country.
Yeah, right. Okay. Got it. Got it. Clear.
Okay, so first aspect was to become non-resident, and within that, the first item was to cut your ties with respect to your family.
Mm-hmm.
Second important thing is your home. And when I say home, it doesn't mean any real estate property, right? You can have 10 different properties in Canada. You can own that. Um, they can be rented, right? But you
Mm-hmm.
cannot have a vacant place in Canada because then that is your home. So the
Mm-hmm.
concept of cutting your ties is that you cannot have a place of abode, the place that you call home or that you return to um, when you come to country. So you should not have that vacant home waiting for you when you return. Doesn't matter if you live there 1 day, 1 week, 1 year, or it remains vacant whole year. That is still vacant. I understand sometimes the concern might be, especially if that's a paid off property, you don't really have too much debt on it, and you don't want to rent it out to, not to get into all those technicalities or, issues with respect to tenanted properties and all that. So you might want to keep it vacant. That could be your choice, but unfortunately, that would be considered a tie to the country. Because in eyes of CRA, you have a place that you call home and that you can return to, and that is your abode. So that would be a tie. So you must rent out if you are living on a rent, then just cancel the lease and move on. That's okay.
Mm-hmm.
But if you are you own the property, you were living there, first of all you need to rent it out and then move out. Obviously there can be exception, like if you got a job, you had to join in April, you left the country end of March, and it took you until June to rent the property, or you might have to do some minor renovation before you could rent it out, and then it was rented out in June or July. So that is acceptable as long as there's an intent to rent that we can show.
Mm-hmm.
But the key point is you cannot have two homes. You cannot have one home in Canada and one home in UAE, even though that Canadian home is vacant, nobody's living, you don't go there, you go there just for a week. That you cannot do because that would affect your ties with the country. So these two are considered major ties which you must cut off. There's a third tie which CRA doesn't call it major, but I won't call it minor either. It is somewhere between major and minor. You cannot have a Canadian employer waiting for you, right?
Okay.
So you cannot have let's suppose you were doing a job in Canada and then you decided I want to go to UAE. And you told your employer, okay, I want to go to UAE, I want to explore options there. You had been a loyal employee of your employer, and he said, okay, I'll save your job. You just go, explore. I'm not paying any salary to you. You just go and explore. Um, if everything works out, well and good. Or if you want to come back, you have this job with me, right? Um, that is still an employment. From residency point of view, that is still a tie to the country. You have a job waiting for you.
Hmm.
Or another exception is that you are a Canadian, you are employed with a Canadian employer and physically present in UAE. That still means you have a Canadian job. Or you are part of a UAE government or armed forces and deputed into or stationed into some country outside UAE doesn't make you non-resident. You are still a resident. So
Hmm.
you or your spouse cannot have a Canadian employer or Canadian job waiting for you. Otherwise, that's another tie to the country. So these three are major ties which should not be there. Besides that, there can be minor ties. For minor ties could be your driving license, your passport, your bank account, your credit card, your personal belongings, your memberships, and all that stuff. Now the thing is, minor ties are considered as part of overall picture. So the government does acknowledge that you can still have some minor ties. For example, you will keep your passport,
mm,
you may keep your driver license, or maybe you will exchange your driver license. So that depends on the choice and depends on the country you are going to and the laws over there. So driver license. Another minor exception could be your bank account. If you have a mortgage, you need to keep the bank account. You might want to keep a credit card as well because you might have to do some purchases or some payments while you are away. So, so these are the minor ties. But my recommendation is that minor ties should be kept to the minimum, because even if you don't do anything, you will at least keep a passport. You may keep a driver license. You will have a mortgage. You will have a credit card, and you will have a bank account. So at the offset, I can count 5 ties already, which are minor. So let's not add unnecessary ties. If you have 10 credit cards, just keep one. So minimize, keep your minor ties to the minimum. One of
mm,
the most unnecessary minor tie I suggest is your personal belongings, right? So personal belongings, I understand there might be some emotional attachment with different stuff, or you think, okay, I would come back again to Canada. I don't want to get through the hassle of finding new furniture or finding,
a new car.
a new car, or even this Canada Goose jacket I've been wearing for 5 years and it has always saved me from the wind. I don't want to let it go. Or these boots fit me perfectly, save me, stuff like that. So, or sometimes it's a car. I bought this expensive car. I don't know how I will get it again and stuff like that.
Mm,
And
mm,
people want to keep it, or they want to let others use it.
mm.
Um, don't do that. That is an unnecessary tie to the country.
And things
Um,
will add up once something opens up. Then these things will add up for sure later on.
yeah, even your library membership is a tie to the country, right?
Mm,
So if they start to keep getting your ties, how many things you are going to cancel before you leave? So
mm,
if somebody really gets into finding your ties, they can find hundreds of ties. So
mm,
just keep it to the minimum. And see, for others, we can have a reason. Credit card, yes, I need the credit card because sometime I come back to visit and I need to make some spending, or I have a property, a tenanted property. Sometime I need to make payments online and I need that. That you can explain, but those personal belongings is the last thing that should be there. Um, if you want to become non-resident.
It's very technical actually. I'll come back to the point about the house, because house is something which is usual. I have seen one family, by the way, who left Canada for 5 years or 4 years, something like that, and they left their home vacant back home, and they were in Pakistan, I think. And during this time, a lot of things happened. Even their house was very good. It was a kind of mansion, but they had to leave it there for some reason, and they did not rent it out. And during this whole time, they were not also actively monitoring the house. And I think there was a pipe burst, water leakage or something happened, and it was all drowned. So they had a very bad experience. But anyways, I'm not sure how did they tackle this tie thing, because they wanted to keep themselves away because of the tax purpose. So I'm not sure. But there's another thing that I wanted to talk about is this book, which is called as Balance. This is written by Andrew Hullum, and this guy, he came to me on to my podcast as well. And he is a Canadian, and now he's not based in Canada. He's based in Bulgaria, I think. But he comes to Dubai very often. But in 2001 or two, I think he was uh, I think he was a secondary teacher, and he has been writing about personal finance in Canadian publications and whatnot. But in 2001, he told me that he took a sabbatical, and his employer, who I think which was Ontario's government, because he was based in Toronto, and he was teaching in one of the schools there. And he left Canada, and on the terms were that when he would be coming back after 1 year, he would still be employed there, and during this time he would be paid in full, because he was already getting some deduction, and he planned like that. Now I'm thinking that he would still be a Canadian resident, right? All this
Yes.
time
Yeah.
he was the resident, and he would be paying taxes in case, if applicable.
Yeah,
So it's
that is
very
a
difficult.
very
Mm,
yeah, sorry. That is a very common scenario with government employees. They have these kind of options available to remain an employee and move out for some time. But yeah,
mhm.
that affects them from the tax or residency point of view.
So this is very technical thing. I don't know, uh, because I talk to a lot of people day in day out, from Dubai, from Canada, everywhere, and they don't. I am 100% sure nobody is going so deep into these technical things. So let's say if somebody did not know about these laws and left Canada and kept their house like that. Let's talk about this house, because this is something which I can imagine of, that a lot of people can do without knowing even, and without any benefit as well. Like, you're doing something which, if probably you if you would know, you would not commit this. But let's say if you don't know and you left Canada and you left the home like that, what will happen next? Like, how would the penalty comes into effect if this is the case?
Okay. So for house, I missed one point. Let me add that as well. Not only you cannot keep it vacant, you cannot give that to a related party at anything less than a fair market value. Sometimes, there some people just decide that, okay, my sister, my brother, or whoever would live there, and I just want them to live there so that the house is not vacant, somebody's taking care of it. I don't care about rent. The market rent is 3,000, you give me 1,000, right? Because they are keeping, in my mind, they are taking care of my property, so that's kind of an compensation for that.
Mm-hmm.
Again, that would affect your ties to the country because you have rented at less than fair market value to a related party. So not
Mm-hmm.
only it has to be rented, it has to be rented either to an unrelated party or to a related party at a fair market value. So okay, now let's coming to your specific question. Yeah, if something has happened, let's suppose I moved 4 years back and I kept my house vacant. Um, at that time, the correct way to do it is that, first of all, rectify the situation, right? And get it rented. And from that point, then we need to see, again, that is something we can discuss on one basis when the client comes in, how to tackle that situation. But first of all, we need to see that how they use their house. Did they actually kind of kept on coming and going, like how many times in a year? That shows the intent, right?
Mm-hmm.
And then, we can see to what extent we have to communicate and how to communicate with CRA on that, if at all. And if audit comes out, so normally this is, most of the tax system is based on self-assessment, self-declaration. So it's not like that I will come to how to communicate about your non-residency to CRA, but it's not like that CRA would be, coming after you, or every person who says that I'm becoming non-resident, CRA is appointing a detective after that person. Okay, check what happened to his house, what happened to this. Is he really doing this? Is he really doing that? The assumption is that you know the laws, you have followed the laws. So let's suppose if an audit comes up and that was an ignorance on that person's part. First of all, in tax, ignorance is not an excuse.
Mm-hmm.
But you can still apply for a relief based on the facts that how you use that house.
Mm-hmm.
The rule says you have to rent, but then there is always an option to say that, okay, I didn't know about it. And just not just the fact I didn't know about it, I never breached that intent which was there. So the whole intent of this requirement is that you should not have two homes, or you should not have a home in Canada that you call as home. So then the next question would be that how you use that house, right? If that person was kind of going Canada every month, staying 1 week, or every 2 months staying 1 week, still less than 183 days. So by the way, if somebody becomes a non-resident, clearing all the requirements, okay, but still they spend 183 days in Canada, they are a resident and they have to file tax. So not just you have to cut ties, you cannot be physically in the country for 183 days. So I began my discussion with the fact that 183 days is a misinformation, which is still true. That the fact that you are not there 183 days doesn't make you non-resident, but the fact that you are there for 183 days, it does make you non-resident, no matter your ties. So, if that person came to Canada for 120 days and that was spread over months, and every time he would come, he would live there, which means he has used it as a house. For the 12 times in the month, he used it, or in a year, he used it, or maybe 6 times in a year, he used it, which means he could not rent. Even if he wanted to rent, he could not rent, right? It's
Hmm.
not just that it was an ignorance, it was a planning on his part not to rent it. So for that kind of person, it is difficult to justify. But for some other person who just missed this requirement and He just came for 1 week in the whole year. He can probably justify better.
Okay, okay. So yeah, so there are justifications possible once you go into deep. So anyways, and now that someone has fulfilled all the requirements to let's say become a non-resident, and he has gone to, let's say he has came to Dubai now with his family, and his house is no more there. So in that case, I feel that it's best to dispose of the property or liquidate your assets. What about, by the way, we've talked about homes, but let's say what about other investments, like let's say stocks investments or these kind of things? Are these the
Okay.
same? Yeah.
Okay, so let me talk about it. Let me talk about the communication part as well. So as far as your investments are concerned, they are not a tie to the country. So you can keep whatever investment you want to keep in Canada. That does not become your tie. How it affects you from tax perspective will come to that. But the another aspect was with respect to the communication to CRA. So once you cut your ties, then obviously you need to communicate to CRA that you are non-resident. There are typically three ways to communicate that. First option is to call CRA and tell them effective this date I am a non-resident, and that's when it gets recorded in CRA system. Obviously, when you file tax return for that year, you must also declare in your tax return as well. That's the second way. When you are filing the tax return, you must declare. So there is a question in the tax return that on 31st of December you were resident of which province, and then you have to select from the drop down. So one of the option is non-resident. So you have to select that you were non-resident on 31st December of that year, and then it will ask you for the date and other follow-up questions. So that's the second way to do it. And the third way is a form which is called NR73. It is a very detailed form, not tied to the tax return. Again, these are options, different ways to record your non-residency. So NR73 is a very detailed form, not tied to your tax return. And it goes to the extent of asking that do you have any personal belongings in Canada or not? Do you have personal belongings in UAE or not? Do you have any memberships in UAE, like library membership or some clubs membership, stuff like that? Where does your kid study in Canada or in UAE, wherever they are? What address do you live in? Do you have a telephone number in Canada? Have you by the way, that is also a minor tie to retain a telephone number in Canada. So do you have a telephone number in Canada? Do you have a telephone number in UAE? Do you have a mailbox in UAE? So these kind of detailed question. The idea of that NR73 is to compare your ties in Canada versus compare your ties in other country. And so that form I normally recommend when there is a complex situation where you want some determination from CRA, because in response to that, CRA will write you a letter and confirm you that based on this information, we accept that you are non-resident, or based on this information, we cannot consider you non-resident. So that's mainly for that should ideally be used for a complex situation where you think you need some word from CRA directly on your situation. So these are three ways to communicate with CRA when it comes to non-residency. And these are optional, whichever way you want to use, but you cannot do that. Okay, I mean, you cannot have a contradictory information. You cannot do that. I told on phone that I'm non-resident, but when I file my tax return, I do not tell them that I'm non-resident. You have to tell them. You have to be consistent about it. Coming to your investment question with respect to the investments. So as I said, investment doesn't affect your ties to the country. You can have investments. The way investment affects is with respect to your exit tax and with respect to your future taxation, right? So with your permission, it would be a good segue to come to the exit tax and discuss all the asset classes as far as the exit tax is concerned. So there is a very common term used that there is an exit tax when you leave Canada. In technical terms, there is no such tax named as exit tax. The idea is that when you are leaving Canada, your assets are considered to be deemed disposed on that date that you become non-resident. And when I say deemed disposed, that means it is assumed that they are sold and purchased by you again on the same date. And just like whenever you sell your asset, you have to pay a capital gain. So there is a capital gain involved on your worldwide assets when you are becoming non-resident. There are certain exceptions, but that's the whole idea of this exit tax, that when you are leaving the country, CRA wants to make sure that the assets you own or the unrealized capital gain you have accrued on all those assets CRA takes its due share before you become non-resident, because in more often than not, in most of the cases, for most of the assets, CRA might not have control on recovering their share of capital gain when you leave.
If you are a resident of a GCC country and you want to invest in the US stock, I have got one platform for you which I invest through as well. This is called as Sarva. Sarva has three modules which you can invest through. One is Sarva Invest, the other one is Sarva Trade, and then Sarva Save. All three modules provide you the investment opportunities that you want, and you can invest in the US stocks. It can be Microsoft, it can be Amazon, it can be Google, any individual companies you want to invest in, or you want to invest in the ETFs, or you want to invest through Sarva Invest, which is a platform that basically does not require you to have any kind of financial knowledge. If you want to open the account with this platform, the link is in the description. You can use that link and you will get $50 of referral bonus once you open the account and transfer the funds. Terms and condition apply. Now let's get back to the video.
So, for example, if I had a crypto account, okay, and I am leaving the country, I bought that crypto while I was a Canadian citizen. I bought it for $10, and when I'm leaving the country, that crypto is $16. So $6 is an additional is a capital gain which has already happened on that. I haven't sold it, so that's an unrealized gain. And there is always a possibility that by the time I sell it after becoming a non-resident, it might be at 12. But CRA doesn't care about it because it cannot foresee what the future value will be. It cannot enforce you to pay capital gain because now you are out of the country. And it has no visibility or line of sight on your income, because if the income is not sourced in Canada, you are not supposed to declare that, right? So, because of all of these situations, CRA wants you to pay the capital gain on your assets when you are becoming non resident. So that's what people typically call
Exit tax.
exit tax. So that
Ah,
is actually the capital gain you are paying on the unrealized gains on your asset. Okay. So now let's go asset by asset. So the cash in your bank account, the liquid cash, which is your after tax money, no capital gain. That's your money. Just take it. Um, your properties based in Canada, you don't have to pay any capital gain on that if you become non-resident, if they are based in Canada. But your foreign properties, you will have to pay capital gain because they have no control. Okay, your Canadian properties, they have a control, so you don't have to pay. Your investment accounts. So registered
so
investment accounts. Yeah, sorry.
sorry, if let's say if I have a property and let's say I've purchased it for $1 million, and now I'm leaving Canada, it's at $1.2 million, but I don't have to pay this $200,000 of capital gains tax or any kind of tax while I'm leaving, because this is a physical property which is
Yes.
based in Canada. And if I come
Yes.
back and let's say the property price again is $1 million, so it's fine. It's there is no nothing has changed. Okay.
Yes.
Okay.
The only thing is that what we recommend to client and what's the right way to do it is that when you become non-resident and filing your last tax return, you should, because assuming that was a principal resident, if that was a rental, then that's fine. That's has ever been a rental. So you are, whenever you pay the tax, you would pay based on your actual purchase price. But let's suppose there was a property you were living in, and as you know that there is a capital gain exemption on your principal residence or primary residence. So in that case, what we suggest client is that in your last tax return, when you are becoming non-resident, do declare it as a deemed disposition, which would have zero tax because until that point that was principal residence. But at least that would bring the value of the property on that date into the CRS notice,
Okay.
right? So that
Okay.
CRA would know that, okay, the date this guy left this country, his principal up till this point it was his principal residence, and the value was, let's suppose at that time, 1.2 million. So when next time you come back to Canada and you sell the property, or you don't come back to Canada, you just sell the property, and your property value has for some reason gone down to 1.1 million, so that's actually a loss.
Hmm.
You can get the benefit of that loss if you have other investment income or capital income. You can get the benefit. So yeah, so the point is that you have to get your value recorded, although that would not trigger any capital gain if it is your principal residence. If it is not a principal residence, it has always been a rental property, then that's fine. So you don't have to pay any so-called exit tax while you are leaving the country on your properties.
Okay.
So
So one
properties, yeah,
yeah, one question here. So let's say if you're saying that I am now that I've left Canada, and now At that point, when my property was at 1.2 million, the original price was 1 million, and now I came back and the property price is 1.1 million. Which amount should I be taxed at? 1.2 or 1.1?
If you
If
are
I come
selling the
back,
property, I
yes,
mean, you came to Dubai and now you are selling that property, and that is now 1.1 million.
yes, yes.
Yep. So in that case, you actually have a capital loss of 100,000.
Okay, so from 1.2 to 1. No, but the original price was 1 million.
Okay.
Then when I was leaving it, it was at 1.2, which I reported as well.
Yeah.
Now
So
it's 1.1.
when you reported 1.2 million, you told CRA that from the date of purchase till today, I was living here, so I would not pay any capital gain. So now CRA has stepped up the value to 1.2 million as your on that date as your starting point, or what is called adjusted cost base.
Okay,
So for CRA purposes, their counting is starting at 1.2 million, because up till that point it was a principal residence and there was no capital gain, right?
okay,
So they would treat it from 1.2 million. So you sell for 1.1, you had a value of 1.2 and you became non-resident, so that's a loss. So that can happen, but more often than not, it's usually a gain. And
yeah, but
people,
again, I'm thinking if something happens and if the property price depreciates, then you are paying the tax on $200,000.
you're not paying because that was a principal residence. You did not pay.
Okay, let's say if it's not a principal residence, and
Okay.
hmm,
Yeah. So if it's not a principal residence, then yes, it's 1.1 versus 1 million. So your actual gain is 100,000. Then you are not paying on that 200. You don't need to declare anywhere when you are leaving. I mean, you don't have to consider it a capital gain deemed
hmm,
disposition.
hmm, hmm,
It's
hmm.
simply you bought something for 1.1 million. Yes, it went up to 1.2. Doesn't matter. You have not paid any capital gain on that until while you are leaving. And then eventually you sold it for 1.1. So the real capital gain calculation is 1.1 minus 1 million. So
Okay,
yeah, they don't pay
okay.
on that 200,000.
Okay, good. So, I mean, I don't know. This is too technical, but it's very informative for someone who's watching it for the first time, because this is something for, I think it's a lot of people would not be knowing this, and maybe this affect your one-to-one appointments as well. Maybe people know before with this podcast maybe. So the next question I want to ask you is about the stocks. Maybe you can carry on your conversation and then we can continue.
Okay. So yeah, so for property, I think we have dealt enough. So if it is based in Canada, there's no capital gain. The only thing you need to keep in mind is, and that we can touch upon later as well, that if you sell your property after becoming non-resident, there are different implications than if you sell while you are resident. So we can
Mm-hmm.
pick this point later. Now let's move to the investments.
Mm-hmm.
So registered investments, your audience might know that in Canada there are certain investments which are regulated by uh, laws which are related to some tax advantage. For example, RRSP, TFSA, FHSA, RESP. So registered investments, no capital gain. I mean, you don't have to pay any capital gain while you are leaving the country. It's not part of that so-called exit tax. It is excluded. So registered investment, you are fine. You don't have to worry about it. As far as the capital gain or exit tax is concerned, non-registered investments, yes, that's where you will pay your capital gain. So if you had, Apple's stock bought long ago at, let's say, $10, today it is $45, you don't plan to sell it for rest of your life or until you retire. That's your kind of bounty stock. You just got it out of the luck and you don't want to sell it. Okay, don't sell it, but government wants their cut of capital gain on that $35. So that you have to pay.
Mm-hmm.
So far we have seen one category where you have to pay that tax, which is your uh, unregistered investment, the typical investment outside of TFSA, RRSP, and all that. If there's a capital gain, unrealized capital gain, you have to pay tax on that. Um, Besides this, another asset category which is often ignored is your corporation. So just like if you own a share of Apple, that is your asset. If you have a corporation where you are 100% or 50% or whatever percent shareholder in Canada or elsewhere in the world, that is also your asset, right? So if that corporation has certain value, now the biggest challenge is to ascertain the value of that corporation, because most of the time that would be not a public corporation, that would be a private corporation and some small business, or maybe just a corporation you form to do some contract work or stuff like that. So if you have a corporation, um, then the real question is, does that corporation has a permanent establishment in Canada, or that corporation does not have permanent establishment in Canada? So if you own a restaurant, the restaurant will not move with you when you move to Dubai, right? So that has a permanent establishment in Canada. So you don't have to worry about that particular corporation. You don't have to pay any capital gain tax on shares of that corporation. But if you own a corporation which, let's suppose, which provides architectural services, you are the only employee. That corporation provides architectural services. So that corporation essentially moves with you, right? So if you move to Dubai, the permanent establishment, or place of effective management of that corporation will move to Dubai. So that is a corporation where you might have to pay capital gain. So that is another part of tax planning you should do before you move out of Canada, to consider if you have one such corporation. Instead of waiting till the end and declaring it part of your worldwide asset for this calculation, just dissolve it beforehand, right? Obviously,
Wow.
dissolving would mean you might have to give some dividend or stuff like that. That
Hmm.
can be planned, but don't leave it till the end that, okay, now I have already moved last week or last month. I have cut all my ties, but I have this corporation, because that may be subject to capital gain. And more than capital gain, the problem is ascertaining the value of that share,
Hmm.
right? So again, this is one of the unnecessary tie, which you, not really tie, but unnecessary asset you are just carrying with yourself. So, that's where another aspect of tax planning comes.
So this reminds me of issue here in Dubai as well. Let's say a lot of people, while working here, opens a company, and they have a trade license. And what I've heard that, and I've been through as well, that once I open this trade license, even as e-trade license, a smaller one, that as well has to be closed in case you're not anymore doing the business or you're leaving the country. And it's a process in itself. So I can imagine now that how important is that for Canada as well, especially for the tax purposes if you're leaving. So let's say if I'm a let's say a software developer and I'm providing that service, and now I have some contracts in Canada, and now I've got a job in Dubai. So I want to keep on working on Canadian contracts as well, because those are remote working that I can work on. And I've got a job in Dubai. I'll come here in Dubai as well, and I'll start working here with my family too. So in that case, I have to forego my Canadian contracts and Canadian company if I have to be a non-resident, if I'm
Um,
understanding it correctly.
Not exactly. There are ways around. So, for example, um, the only restriction, I mean, you can even have the Canadian corporation. The only point is that is not going to be a tax advantage situation, because if it is a corporation in Canada, for now, let's forget about capital gains. So let's suppose there was no exit tax or anything like that, or that corporation was just a zero value corporation. You just retained it, you moved to Dubai, and now you are getting contracts and you want to do it under that Canadian corporation.
Hmm.
So that's where my role as a tax accountant, cross-border tax accountant, would come in, because if you have the Canadian corporation doing that business, so that means the money goes into Canadian corporation. The income you earn net of expenses, you have to pay 12.5% Canadian corporate tax on that. Still, the money is not yours. Then you need to take that money out as a dividend, and on that dividend you will have to pay around 25% withholding tax, and then the money reaches your hand, right? Let's suppose the contract was for $100, and let's suppose the net value was $100 after all the expenses. And so that would mean, first of all, you paid 12.5% tax, which is roughly, so you are left with 87.5, and then you gave that yourself as a dividend. So there was another withholding of 25%. So the money that gets into your hand is, I would say, another 65, 67, maybe $70. So you lost almost 30 dollars out of that money. So that is not tax efficient. Although nobody is stopping you from doing it, you are Canadian citizen. You can form a corporation while not being a resident. And by the way, sorry, that 12.5% is not applicable. The corporate tax rate would be 25% because 12.5 is only for Canadian controlled corporations. So that would be 25% plus another 25%. So that's not a tax advantage situation. In that case, I would recommend either to create, if the contracts are big enough that, the licensing cost in Dubai is, worth it for that, then create a company in Dubai, get that done. Other option is just do it personally, as an individual from Dubai, get the money in your Dubai account. That is still a subcontract. And in Dubai, as you know, that if you are a natural person, your sales is less than 1 million dirhams. You don't have to pay any corporate tax. So that's second option. The best option would be to create a US LLC. It might be surprise to a few people that to form a US LLC, you don't have to be a US citizen or permanent
Yeah.
resident or anything at all. Yes, there might be some challenges in getting the bank account open. You might have to visit there or just rely on those fintech type of bank accounts. But once you open your LLC, you have account set up, or there might be a challenge that the company who is giving you the contract don't want to deal with a UAE company. They don't know what Dubai is, or they don't want to deal with a person sitting in UAE or sending money to Emirates NBD account or FAB account. So, you can form a US LLC. That US LLC has, let's say, a Chase bank account, a reputable bank account. That LLC might have a good payment processor as well. Um, and that LLC can build that Canadian company, which should be acceptable in most of the scenarios. They should be happy to pay a US company, so that person gets the money under that US LLC. And now the surprising part is, while US is very harsh in taxes to its own citizens, if you own a US LLC with no effectively connected income in US, so in that case, there is no effectively connected income in US. You don't have any employees, any office, any store, warehouse in US. So you can even have a customer in US, but if you don't have any employee or any place of effective management or customer in US, and that LLC is owned by a foreigner, non-US person, so you don't have to pay any tax in US for that. There are still filings you need to do, but you don't have to pay any tax. The
Wow.
concept is that you will pay tax in your home jurisdiction. In
Hmm.
this case, your home jurisdiction is UAE, where there is
Right.
no personal tax.
Hmm.
Right? So this could be a very good way of solving all those problems. If the contractor, if the that company has a problem with paying in a UAE bank account or paying to a UAE company, the front could be US LLC where you get the money, and that is taxable for the foreign person's home jurisdiction, which is UAE, where there is no tax until 1 million dirham of sales if it's an individual. Or if that LLC is owned by a UAE company, then the normal corporate tax is applicable. And we know that first 100,000 is not taxed, first 100,000 US dollar is not taxed and all that stuff. So yes, that person can do that from the Canadian through a Canadian corporation, but I would say not to do. And again, that is creating another unnecessary tie for that person. So I would rather take the US LLC route for that person, to make it more tax effective and less applicable for in terms of the residency, affecting their Canadian residency.
Right. And the last question from my side for this specific thing is, you mentioned that, let's say, if the corporations, how would you assess a corporation that, if it's a single person corporation, is it easy to assess the value of it, like in terms of capital gains? Is it a
That is
subject?
the most tricky part, because see, there is a field which is called chartered business evaluators in Canada, and there would be equivalents in US as well.
Mm-hmm.
Um, they are trained to, and they are certified to do the valuations for the corporations, those private corporations, and they have their own methodologies to do that, and those are pretty much acceptable to CRA. But the problem is they cost a lot, because they are not really meant for very small corporations.
Hmm.
So they cost a lot, and sometimes the value itself might not be that big that they pay that much of money to a CBV. So there are ways to find the value, but they are not cost effective. That's the problem. The next situation is you would just use some rule of thumb. For example, in case of accounting firm, there's a rule of thumb that the value of firm is anywhere between 1 to 1.25 times of the annual sales, right? Likewise, there's some industry, the rule of thumb is 3 times of EBITDA. So you might have to use some rule of thumb. But the worst part is onus is on you to prove. So if CRA questions that, they don't have to say that we don't think it's $10, we think it is $20 because of this and that. Or they can say that, but they don't have to justify. The onus is on you to prove that it is $10.
Hmm.
That's why I said it's an unnecessary hassle. You might not end up paying any capital gain tax on that. Even CRA may get satisfied, but that's just a lot of back and forth you have to do. In order to prove your value, you might have to attach so many documents, so many other information you might have to collect. So that could become costly. So that's why it's recommended not to retain any such corporation if you don't need to.
Right. So still, I think there are so many complexities that one has to go through, especially if they are leaving for anywhere in the world from Canada, because then you have to make sure that you don't find you don't end up paying something, or let's say in later part of your life, you when you come back, you don't see yourself paying a hefty amount of tax bill. Anything else before we move on to, let's say, someone from Dubai to going to Canada?
Yeah. One last thing. So what you need to do, um, once you are leaving Canada, what you need to do, in terms of protecting yourself for the post non-residency period, or once you
Mm-hmm.
become non-resident. So from that I mean that, let's suppose 31st of March you are moving out of the country. So whatever happens with you in Canada, whatever economically happens with you in Canada from 1st April, what you need to do for that. Okay, one part was exit tax. You did your exit tax and you are done and you were moved out of the country. But you might still be generating some income in country after 1st April. So what to do for that? So again, we will go to all our asset classes. First of all, your registered investments, they can grow tax free as far as Canada is concerned. That
Hmm.
might be taxable in your new country, new home. Obviously, UAE doesn't have personal tax, so it's irrelevant. So let's not go there. But at least from Canadian perspective, that is tax free. They can grow tax free, but you cannot invest into it further. That is a one big challenge. So make sure that you don't have any pre-authorized debits or stuff like that, or you don't mistakenly put money into your TFSA or RSP, because I have seen a situation where there was a client of mine living in UAE. She became non-resident back in 2011 or 2012, 2011 actually, and she came to me in 2022 that I have never declared my non-residency. I
Hmm.
want to declare it. I said, okay. And she had not filed taxes for a couple of years as well. So we just caught up on everything, filed taxes, everything was done. It was great. But once we did everything, she got a letter from CRA that here is your bill for $14,400, which should not have been the case, but he got it. She got it. The reason was, back in the day, in sometime in 2011 or 2012, she did invest, or somehow $1,000, or yeah, I think that was $1,000. $1,000 got invested from her account into TFSA, and the penalty of investing money while you are non-resident is, or while you are not allowed to contribute, is 1% per month. So 1% per
Oh.
month was $100 times 12, so $1,200 in a year. 12 years was 14,400. So that was a hefty bill for her, an unexpected bill for her, and not really worth investing that $1,000. Eventually, we got it waived, but she still had to pay it. Then it was waived, and she got her money back. But again, that's a hassle. So first thing you have to do is make sure there are no pre-authorized debits, or money is not going into any registered investment. Second thing you need to do is you need to tell all your payers of any sort of Canadian income. So payers means your financial institutions where you have those investments. Payer could be your tenant who is paying your rental income. Payer could be anything else. You might have in a very exceptional scenario, you might have some written sub book and you are getting a royalty out of it, right? So whoever is paying the royalty for that book, he's also your payer. So you have to tell all your payers that I am a non-resident, and by law you are obliged to deduct 25% from whatever income you are giving to me and pay it to the government, right?
Right.
Financial institution, it's easy. You would tell them, they know what to do. They do it all the time. The real problem comes with your tenants for your rental property. they are not used to of paying it, and obviously tenant would get kind of disturbed at what am I doing, why I need to pay to CRA, why CRA is involved into this. I just got a property from you. Normally, I just pay the rent to you. Why do I get into this? So that's another tricky part you have to consider when you are becoming non-resident. That if you have a rental property, the rule says that 25% of the gross rent is the rent before your mortgage interest, before your property tax, insurance, anything. 25% of the gross rent must be paid to CRA every month. So
Hmm.
January rent, your rent was $4,000 that you got. Your tenant is supposed to pay $1,000 to CRA and 3,000 to you by 15th of next month. Um, Practically, tenants wouldn't do that. And CRA is least concerned who is doing it. They are more concerned that they get the money. So most of the time, it's the landlord who is paying from their online banking. So tenant would pay to the landlord, and landlord would pay to the government 25% of the rent, gross rent. That could be a huge amount, obviously, from cash flow point of view, considering the fact that the mortgages are very high these days, and there's already a lot of outflow which is not considered in this calculation. So by default, your 25% of the rent goes to the government as a tax. That is a final liability. You do not need to file any tax return. But that's a lot of money. So what a lot of people do is that after the year ends, they still file a tax return, which is called Section 216 return, which is specific to the rental income for non-residents. So they would file that return and they would get the money back from the government based on the net expenses, right? Um, that can be done, but that is not a recommended way. And the reason is government has already provided an exception and provided a way to pay net rent from the advance from the get-go, and that is called what is called NR6. So you can take a prior approval from CRA that I want to pay net rent. I want to pay 25% of the net rent to CRA every month. And then I will file return at the end of the year. And whatever is extra, you can refund me, or whatever is less, I'll pay you. You can take that approval. The only catch is that you, first of all, you need to file the return at the end of the year. Now that's a mandatory thing. Secondly, you have to have a Canadian agent. Someone, and that could be any adult person, could be your agent, um, who is based in Canada. That is required because if CRA can't collect money from you, they will go after the agent. So you have to be able to find an agent, and then you can do that part as well. And obviously, that would save you a lot of money from cash flow point of view. Secondly, you don't have to really worry that, what if CRA doesn't give me my money back at the end of the year and I paid 25% of the gross, because the rule says it's a final liability and they have already given you an alternative.
Hmm.
So that's a very specific thing for non-resident that you have to consider. And this time of the year, which is December, is when we file for most of our clients, and this is what keeps us busy in this month, where we file NR6 approval for our clients, so that for the next year they have to, and that you have to do every year, so that next year they have to pay 25% of the net rent instead of the gross rent.
Hmm. Right.
So yeah, so income by income I would go. So we talked about the registered investment or unregistered investment, a contribution into the registered accounts, rental property. Obviously, you cannot have an employment income while you are a non-resident. You can have a subcontracting income, you can have a corporation income, you can have a dividend, but you cannot have an employment income. The point is you cannot work for a Canadian employer, or you cannot work in Canada. That is the only thing. Otherwise, you can have a Canadian source income, but that would be taxed different.
Hmm. Right. So what I understand from this is, in most cases, one should try to liquidate whatever investments they have, apart from the registered ones. Even the house, which is very illiquid, but still you try to do that. Otherwise, you have to rent it out, and it has other repercussions. If you're going for a short term, then it's a very tricky situation, unless it's having, let's say, you have a good income coming up from abroad. Otherwise, it's really difficult. Actually, I wanted to discuss two more topics here, but I think we can put it off for the next podcast for us. Like, one was the corporate tax of the UAE, because
Mhm.
you also deal in that, and also the people who are, let's say, moving to Canada from Dubai, or anywhere from the world. So because those are new immigrants and they might have different laws to consider before moving to Canada. So these are the two topics I want to discuss separately. But before ending it up, do you want to say something else? Because this conversation was very insightful for me as well, and I'm sure people who are watching this might find in things which are value to them. So they can contact you as well. I've got the description, the link in the description for your social media channels as well. But let's say towards the end, do you want to say something which we might have missed?
Yeah, so I would say planning is very important. See, there might be a situation where you just got a job, you have to join in 2 weeks. Obviously, I understand you might not have time to plan, but you can still plan that when you actually want to become non-resident from tax perspective. And apart from that, planning is also important. As we said, that there might be a lot of capital gains involved. So timing is very important. Sometimes becoming a non-resident in November is not as good as becoming a non-resident in January, because you get two separate tax years for some of your income to be liquidated and considered for capital gain. So uh, given a choice, timing would matter a lot. Given the choice, how you plan it will matter a lot. And as far as liquidation is concerned, again, if you have to liquidate, it will matter a lot. There might be situations where, especially for the crypto, those who are holding a big chunk of crypto, I have seen people in the past who are moving, who are becoming non-resident of Canada just to, realize their crypto gains, because they had a very huge holding in crypto and they thought that, it is going to go up. Right now it is down. This is good time to become non-resident. Obviously, they were not the people with the kids in the school and all that stuff. So they just, packed their bag, left the country. They didn't have much ties, but they left at the time when the crypto was low, and they knew that, or they thought that it will go up. And obviously they became non-resident at that time. They didn't have a capital gain, and then eventually when they moved out and the crypto was high, which I would say maybe all-time high, and they were a Dubai resident, they sold it. They didn't have to pay any tax on that gain. So
Mm,
timing matters a lot, planning matters a lot. So take out time, make sure you contact a professional to work out on these things, to help you navigate these complexities, so that you can be in your new country trouble free with more peace of mind.
right. No, this is actually for taxes. It's important anywhere in the world, more so in Canada, because so many complexities are involved and many things are not visible to a common man from the perspective of tax, from a tax consultant's point of view, because you can see a lot of things from your experience as well as a lot of things that you are doing on daily basis. So I'm sure, and I've got your recommendation from Behrouz as well, a lot of other people as well who are using your service, and it's been great talking to you. I hope we can do more podcasts. And as I said, there are two more topics that I have with you. So probably we can have a separate podcast for both of them. And whenever you come to Dubai, let's say, we can have an in-person podcast as well.
Definitely, definitely.
All right. Thank you
Thank
very
you.
much.
Thank you.